The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Welcome to How to Money with Cole and Baileigh. I'm Cole.
And I'm Baileigh.
We're financial advisors at Full Swing Financial, where we coach people every day on their money.
Each episode, we cut through the noise and focus on the financial decisions that actually matter.
Our goal is simple, to help you feel more confident and more in control of your money.
Let's get into today's episode. As always, we are back, powered by our favorite coffee, sponsor of today's episode, Stella's.
Awesome. Thanks, Stella's.
I always make the joke when I go in and they're like, what do you want? I'm like, black coffee. And they're like, just black. I'm like, black like my heart, ladies. Let's go. But speaking of, I was literally in Stella's today. A client was there, and it's leading me right into what we're talking about today. What do you think they asked me? What do you think they asked me when I got
What's going on with the market?
Yes, I was stressed last week. Should I be worried?
Should I make a change? Should I what do I need to do?
Which I do love that they're like watching it, thinking about it. I don't want anyone to be oblivious to the market, but it is funny because it ties in. Because today we're going to talk about market volatility. Cole's going to geek out. We're going to let him do his thing, the AI hype, and questions everyone is asking us as clients right now, which that is the number one question we're getting right now.
We are getting a lot of questions on that. And this is, super, super common. For clients or individuals that have money in the market or exposed to volatility, to start asking these questions. Yes. But we always try to look at a bigger, people to zoom out, right? The market volatility is a very narrow window, right? We've just seen this really the last 3 or 4 weeks. Obviously, it's pretty much all based around, two things. One is the Iran situation, whatever we have going on, and really how that leads to potential inflation.
Yes.
And that's really what's kind of causing the stir, because you've seen the tech market has really led us downward, meaning all the really large names that led us for the past 3 years.
Yeah.
They're the ones that really gotten hit the most, which they probably had some room to give back. I think they'd gotten maybe a little ahead of their skis, right, on valuations and things there. So ultimately, long term, it's probably a healthy pullback at this point. And we're I think around 7%, somewhere in that range on the overall. If you look at the S&P and NASDAQ, somewhere in that range. The NASDAQ might be closer to 10. But I want people to zoom out and remember last year, right? Because this is setting up to be, I think, very, very similar to what we went through last year. Now, we were a little earlier in the pullback last year. It started early, or even in a little bit of February and into March, and this was based around what was called Liberation Day, which was the tariff, all the tariff stuff coming into play, right?
It's always when the big headlines are out there.
And what happened? We went through that news, and there was kind of the almost similar thing back and forth, where there was some changes in the administration, things kind of back and forth. The market would react one day, it'd respond the other day, and it took probably 6-8 weeks, about 2 months, to kind of work through the system. And what did we do? We catapulted after that kind of everything cleared up, or we had a little more, and it wasn't like there was a solution. It was just, there was more clarity on how the decisions were going to be made. And the market is like, okay, we can move forward from this. And we ended up about 20% last year. And
I always think that the market has volatility. It will always have volatility.
Natural.
It does not mean it's broken. I think people think when they hear the headlines and, the war, which it is, it's grabs your attention, but that's normal. It just means some uncertainty is high.
One thing for people to always think is, because some people don't really understand how stocks get their price.
Yeah, you should go into that and how even the system.
When we talk about valuation, right, there's generally what's called an earnings multiple, that if you go and you could look up, if someone typed this in their Google or ChatGPT or AI tool that they use, the earnings multiplier on the S&P 500, or the forward earnings, a lot of times is what it is. And then you look at the price chart of the S&P, there's generally a correlation. Or if you look at 100 years.
If you're watching Cole on YouTube.
Yeah, there's a correlation up as the earnings, or EPS, earnings per share, grows. Sometimes, analysts will price it on forward earnings versus current earnings. It's just a different way to look at it. But generally, they stay kind of in line with each other. There's kind of similarities, but every once in a while, you'll get where the stocks get way out of line. You're like, ooh, there's a big difference in that chart of what it looks historically. And we were getting a little there at the end of last year with the tech, with especially like names like NVIDIA, all the, Tesla, Google, a lot of the Magnificent Seven, or what is referred to. And we've kind of gotten back in line and actually even a little undervalued to that chart all of a sudden, like quickly. So that's one thing that's somewhat positive if people, was a market overpriced? Actually, we're now a little underpriced from the largest companies in the world. Now the rest of the S&P 490, right, still has probably room to catch up on things, but that's really where we're always kind of looking, and that's a long-term lens to look in, right? Because we get so short-minded in these period of times.
And I want to normalize it, because even in the good years, the market drops at some point, right?
Yeah.
We're not just green all the way through. So when clients are like talking to you, Cole, and they're asking about the market volatility, how do you get them to think long-term, or even years out or a year out instead of a month, a day, a week? You know what I mean? Because that's kind of the hard part of our job, is really emotionally, and it's usually harder for people nearing retirement, older age. But we had a client yesterday, we were in 401k meetings all day, and she said, hey, I'm 55. Should I move some to cash right now? Should I?
And she had about a 5-year time horizon, probably, or maybe even longer on using the money.
Thank you for that. And she was just like, should I, de-risk because of everything? And we're like, ooh, 5 years is a long time to miss out on some growth. You know what I mean? So go into that.
I think the question that people need to ask themselves is not, hey, when I'm retiring, right? That's important. It's like, we need to have a date, but it's like, of the retirement money that I have, am I using that in 5 years, or using that when I retire? Because there is a difference, right? There's some people are like, well, I'm retiring in 4 years. I was a school teacher. I have IPers. I have Social Security. That's going to cover.
I might keep working, actually.
And I have my retirement funds. But I don't really plan on using my retirement funds for a couple more years until I want to, buy a place in the South or whatever it might be. That person can look very differently from the person like, no, in 5 years, I've got this pool of $1 million and I'm going to start taking $6,000 a month to live on. Much different situation, right? And I think that's the thing that people really need to hone into, is like, when you're looking at retirement, or in the relatability to your portfolio. Gosh, I'm stumbling over my words here.
You're good.
Is how much of that money is going to directly come from the portfolio, right, to live on. And that's
you went through that with her, and you were like, well, you're really not going to use that. You know what I mean? It was a light bulb moment for like, oh yeah, I'm not. We kind of came to that
of like, oh yeah, I'm not really using any of the money probably even in 5 years yet. So it's like, okay, well, we can kind of keep our foot somewhat on the gas, or similar. I'm not saying you can't de-risk a little bit over time, or when you hit a home run or have really, really good years, sometimes it's okay to say, yeah, we've made a lot of dollars. Maybe take a little bit off the plate and get a little bit on the safer side. But
I'm more comfortable with that.
Do it from strength, not from weakness.
We were talking about this yesterday, because me and Cole were talking about people who make these rush emotional decisions in these, what they think is a bad market, which is actually sometimes in a good market, it's just emotional reaction. And usually when your reactions are emotional, you're moving from a place of like, oh, I'm not sure if I have enough saved. Oh, I'm not sure of this. But if you come from a place of power, like you used the example, I had a client that was down, 900, how much, what was it?
Someone that has, they have a very significant amount of money, and they're 10% down is $900,000.
Like, and we were talking about that. I was like, but that's because he can move from a position of power, because he knows he has the longevity of the money, like what it would return. He's not emotionally reacting because he's sticking to the plan, which brings me this. A lot of people asking, do I need to change something right now? Talk through that. Like, do people need to move money? But we're just kind of talking about this. If your plan only works in a perfect market, it's really not a plan.
Yep, completely. And this is normal for as crappy as it feels. Mm-hmm. Very, very normal to, 5% happens basically every year. 10% I think is about every other year or so. And 20% drawbacks about every 4 years. Mm-hmm. So normalize. It's very normal. And generally they're shorter windows of time, right? That now sometimes they're longer depending on, the overall economic conditions. But I think this is a very specific, generally when there's something very, very unique like tariffs or a war, right? Generally the drawbacks are very shorter, right? Versus you go more like global economic recession, things crash. That like the housing, where it affected so many people. And obviously the situation right now is oil prices causing, a lot of pressure on consumers and really the inflationary side. But generally when they're like kind of the one-off events or things going on, they're generally shorter lived, but they can be deeper, quicker, like more violent to the downside. But I always think people need to, in these times where you're kind of the emotion takes over, if you can't handle it, right now, it's really, really bothering you.
Like you're losing sleep.
You definitely need to make an adjustment. Wants things kind of get somewhat back to a normalized condition. Not right now.
Yep.
You got to bite the bullet and just say, I'm going to write it out. But you probably at that point, you were too risky for your situation, or you have unrealistic expectations of what your portfolio
like
can
you
do.
just always expect it to go up. And we were talking about this too, because obviously we talk about the market, we see it, we're younger, but we were talking about like, oh, when we're 60, like I'm still going to be very comfortable with growth oriented accounts because I understand the swings and I prefer to be in the market. You know what I mean? And it's just, if you're diversified and you got long-term plan, even a short-term plan, if you have your plan in place, you're not reacting to headlines, which was a lot of when the market is volatile, there's a lot of headlines.
Generally, anything you're doing in life, are you making, life-changing decisions based on such a short window of time and data, right? If you think, hey, we've been through, it's about 4 weeks, where we've had, a down, real down, negative headlines down. And that's such a short window when you think of a 30-year, 35-year retirement,
especially longevity
or a 90-year life, right?
Yeah.
It's like that is such a small gap. And think of there's so many marketing pieces and different data points out there on different.
That's what I'm saying. We consume those all the time, so we see it.
We see it, and it's generally always a reactionary decision, right? Because the world is emotional, reactionary decision generally, and then it digests and it's like, okay, we're gonna pivot or go this direction, then we kind of move forward.
And it is true. The average investor underperforms the market about 3 to 4% per year, not because of bad investments, just because of bad timing decisions. So when you get out of the market during these times, when you go to cash and you're waiting to get back, and when you let every headline kind of get you, and we also have these conversations too. We do understand there are some people that cannot handle the volatility of the market.
Completely.
It's just a personality thing. It's their situation. And we have, other things we put them in and diversify in and put some buffers on some things. So it's like really knowing yourself and knowing the market. But also, again, you got to have a long-term plan, because if you're always planning year to year, it's so impossible. You know what I mean? You're just always going to move from that reaction. Just like when you don't budget, like you're like, shoot, I got to pay for this and I got to pay for this. Now I can't afford this. It's like small concept, same big concept.
This is another data point I would say for diversification as well. And I know we talk about diversification a lot, but there are plenty of stocks that are up this year in the market. So that's the other thing is like people associate, you see on the TV and everything's down and everyone just assumes everything that I own is down, or it's just negative across the board. And that's not the case. There are things that can perform, and I'll give an example. The energy sector is the only sector up in the S&P, which is because obviously oil shot through the roof, but it's up 5% on the year, right? And the S&P is down, call it 7 to 10%, somewhere in that range. The space, we're up pretty big today, last I checked. But that's the thing. Or you look in the fixed income market or different things that aren't even associated with stock market volatility. And that's where generally people don't just own the market, right? Especially if they own this. They don't just own the S&P 500.
They don't own one stock and live on that stock and hope that stock performs and we're going to retire on that company.
But there has been a lot of asset classes that were kind of, again, my favorite word the last couple of days has been frothy. And think of the cryptocurrency market, the different markets, even the commodities market. We really saw gold's been like crazy through the roof the last 2 years.
And then people will call back, should I have gold?
A historical run for gold, and it's down like 14% this month. So think of traditionally a kind of a boring asset class, really, really down, right? All of a sudden now, if you ran up for the last year and a half, you're probably out, okay, I can give back 14%. But the people that are kind of jumping in and out are kind of catching the fad or the next best thing. You really got crushed if you were like 3 months ago, like, hey, I'm hopping in on this and
I
this
had
and
someone
this.
the other day say, should I put it all in gold? I'm like, oof. That would be wild, but you know what I mean? That is what they hear at work. That's what you hear from your neighbor. You hear in the news, like gold's hot. And then all of a sudden it's, you know what I mean? Those are all reactive. Go ahead, Peter.
I remember in an old podcast, you called that water cooler talk. That's like water cooler investing.
Yeah.
Completely.
Like people are just like, did you hear about this?
Yeah. I mean, it's so common. It's because they're not hearing it day in. And I'm not saying we're like market experts, but we meet with so many. I mean, we met with a wholesaler. I won't say his name the other day. He's like, we feel good about the market, and this is why. Like, we don't want what was he saying? We don't want great. We want good.
Yep. He made a great point. How we have a lot of things, data points that lead to long-term equity growth or stock market growth. He made this play of like, we want good, not great. Right. Because the problem is when you get to great, like, and let's use the jobs market, right? If it's great, you're probably at the peak of where we want it to be. You're probably troughing, rolling over, something's going to adjust. He goes, there is a lot of things that are really good They're not great. They're not bad. That means, hey, it's kind of, and that's where they made a point of like, as long as we kind of stay in that long term, they're very
predicted
bullish.
a good, yeah.
Yeah, very bullish in the market. And he's always like, we're bullish. Okay. We don't give you a time frame though of what we're bullish for, right? That's the thing. I was like, well, what's your time frame on the, he gave us some S&P numbers and things, and we kind of joked, and he's like, that's always the tough part of the game. I
want you to say this because I'm sure there's someone that's like, what does Cole mean when he says bullish? We know, but tell him bullish versus bearish. Like, I think that's important. We don't want, I was talking to someone the other day. They're like, I don't know your language because I was at the doctor's office. We just
assume that.
I was at the doctor's office and I was like, I don't know what you guys are talking about. And they're like, this is our language. I'm like, and she's a client too. And she's a nurse practitioner. She's like, just like, I don't know your language. I use that word
a lot too. Yeah. And there's probably a lot of people, what's the hell is he, why is he talking about bulls?
Bull. It's a bull market.
Yeah. Bull market basically means, or if someone's bullish on the market, they means very optimistic, positive. We're going to go in a positive direction, right? When an analyst says, hey, I'm bullish on this stock, means I think it's a buy or an opportunity to make money. If you're bearish,
we foresee it going green.
Right now we'd be, hey, we're in a bear market. There's more selling than buying. We've been negative, right? Or I'm bearish on the economy, means it doesn't look very good, right? The picture's murky. We're probably heading downwards. That's our terminology.
For another day, I wonder who came up with that.
Yeah, bull versus bear.
Yeah.
I think bear hibernates, right? And bulls charge, but the problem is bulls charge towards red. So eventually the bull market's going to go back to bear. But the bull was what's the Wall Street?
Oh, you're right. You're right.
Yep. The bull on Wall
That's
Street.
a good analogy though.
Yeah, that was.
And it's normalizing again. We can't predict the market. If we did, everyone's like, what do you think? We'd all have, no jobs.
We wouldn't be in our career field.
We're really here not to predict the market. We have data points. We look at it. We prepare for it. We plan for it. But everybody's plan is so different. It's so individualized. Depends what you got. Depends on your goals. Depends on your comfortability. We just always want our clients and people that listen to us to move from a place of confidence and power and not reactionary, not emotional. No one's immune to the emotions. But I'm just saying, if you understand your plan and you understand that this is normal for the market to fluctuate, it's easier to ride out the roller coaster.
And it's the classic, for as painful as it might be, this is the time you should look, if you're a longer term investor.
On discount.
Yep, you should be looking to add money, or hey, can we maybe money that wasn't applied to the market that you thought about applying to the market. These are good times. And I know it's like, because the news cycle will make everything negative, very, very negative, right? But it's like, those are generally, you look in history, when everyone's saying, oh man, this sucks, generally those are really, really good times to buy.
And I want to challenge people who are only hearing their stock market stuff on their favorite news channel. If you keep absorbing that over and over, you're going to keep being emotionally reactive to all of it. And I'd challenge you to educate yourself in other areas of data points. Like, just research what the market's done over 5-year period, 10-year period, 20-year period, and look at what you're in today. Look at your allocation.
Emotion sells. So just always remember that.
Yeah.
All right, I did actually look this up.
Thank you, Peter. I'm so excited.
Bear versus bull came from 18th century London. The terms were used to describe speculators in Jonathan's Coffee House, which is early London stock exchange, with the bulls buying securities they couldn't afford, betting on a rise, and the bears were selling stocks they didn't own. Often called bearskin jobbers, which comes from the bearskin proverb, which was people were selling bear skins before they even caught the bear in the first place.
It's like your speculators. Yeah.
And then they also said attack methods, bulls push upward with their horns, whereas bears strike downwards.
Interesting. We learned something today.
Curiosity killed the cat. Satisfaction brought him back.
That's Peter's point for the day.
Yeah, there we go.
This podcast is produced by Spin Market and Digital. Located in Fort Dodge, Iowa, Spin Market's highly skilled team can help you increase your market by updating your website, improving SEO, designing advertisements, and producing podcasts that will grab the attention of your market. Contact Spin Market today for all your digital marketing needs at digitalagent@spinmarket.com or call us at 515-302-8026. And to learn more, visit our website at www.spinmarket.com. That's digitalagent@spinmarket.com or 515-302-8026. Or visit our website at www.spinmarket.com.
Are you ready for Cole's Corner? if you're listening to this, we need a sound. We're thinking about this every time we go to Cole's
We need some
Corner.
help.
We need an idea like Cole's Corner.
We're not very clever in this room. Well, I'm not.
I was like,
these
whoa,
two, you
whoa,
two,
whoa, whoa,
you two
I'm
are,
creative.
you
It's
two are
just-
much better.
I want some input, like boing, Cole's Corner.
The ones today.
A little
I hate
depressing?
being negative, but I
Sometimes
think we need
you
the
just gotta
awareness.
shed a light on a topic for it to change.
We need the awareness, and I can see this with people around me and
We
different
talk
things.
about it.
Yes, I mean, so first one I'm going to talk about gambling problems. The American Gaming Association estimates that legal betting on this year's men's and women's NCAA tournament will exceed $3 billion. B with a billion. Jeez.
It's too accessible.
54. That's up 54% from 3 years ago. So 3 years ago is about when a lot of the online, like states legalized a lot of the online sports betting and stuff. I think that kind of times up with that. 54%. But a crazy thing about this. So this is came out from a study in UCLA. The source is from CNBC. So they did a story on this. But in states where betting is legal, the odds of filing for bankruptcy increased more than 25%. Isn't that sad?
That tells me someone bet way too quickly, lost way too much, and sees no way out, and they want a quick resolution, which we talk about this, does not fix the problem. It just gets the debt wiped up.
But think to move that percentage of bankruptcy, like that's wild to think of how many people this is impacting.
Was it the Super Bowl? What are the top two? I'm just telling you guys this. Think how much it costs to pay for a Super Bowl commercial. When there's like 4 of the same gambling app, there's a reason they can afford that amount of commercials. That you are not winning. They are winning. Like, and it's really sad to see because we've talked about a few people in our lives going through this, like
I've seen it
clients and
firsthand.
stuff. Yep. And it's not, you are not, I mean, I listen to caller shows, the amount of times people are like, didn't know my husband was gambling 30, and I'm not saying it's all men. I caught myself, but statistically it is young men 20 to 30. It is. And I think it's the addiction of it because you win one real quick and you get that instant gratification of like, oh, I could win. And some people it's just doing for fun, but then the fun turns into, oh shoot, I'm $500 down. I'm $1,000. And then once you win big, now you really want to keep that dopamine of hitting bigger and bigger. I mean, I'm serious. Like
it's just very accessible.
Yes.
Like when it comes on your phone, it's just like people that are have retail shopping problems, right? It's the same concept.
Yes.
Like, hey, you can buy on Amazon and it's in your door, at your door in 24 hours, right? These are, you have to have self-control or the controls. I do, man, these stats scare me though.
What would you tell someone, I'm going to let you speak this. Say there's a 25-year-old guy on here and he has the app. What advice would you give him? And he's like, I'm just doing it for fun. What would you say?
I mean, you need to have some awareness, right? Yes. I'm not saying you can't do it. Like there are plenty of people I know do it healthy. It's fun, fun for them. They keep within boundaries, right? But you need
clearly,
to
according to the stat, there's a lot of people that don't.
You need to understand, like, hey, I'm a disciplined person. I can have some boundaries and still do this. And if I can't, I need to step away. You can ban, people that don't know, I'm sure most that are gamblers know this. You can ban yourself from these apps, and you can, where it's illegal for you to use them. Just like you can ban yourself. You have a gambling problem at a casino, you can blacklist yourself at a certain casino. So even if you get that urge to go, they will arrest you basically if you come on property. Like you can do that and put yourself on those lists. So there are ways out there, but obviously, we're not the fun haters on things there, but when you see numbers like this, it almost makes you sick to your stomach because like this is going to
long-term growth
and the age. I think this is not just younger people. I think the age now, as people get more adapted to technology and cell phones, I think you're seeing older people have these issues just as much as younger people.
And I think too, it takes away from, I want to go into this too. So yesterday we were in a bunch of 401k meetings with participants. So we had a little competition. I won.
Of course you did. You did win.
How many participants? We could just get to increase their contributions by 1%, right? We're going from, 5 to 6, 6 to 7, whatever. And it makes such a little difference long term. But when you're taking this little bit of money of gambling, all of a sudden it's $4,000 a year. That's the money it's knowing your situation.
Yeah, if you're the person that's like, hey, I'm okay with gambling $5,000 a year, but I can't increase my contribution 1% a year in my 401k. You're probably making the wrong choice,
decisions.
Right?
I think again, it's being aligned with yourself. I'm not saying you can't, but like I know myself. I'm an all-in person. People know this. Like whatever I'm due. So there's some things I just don't mess with. I'm out. I'm out because I know my personality. And if you're that personality, it's knowing yourself, having a plan, and also just the realization, like, it's a very addicting thing. Especially I think about a 20-year-old, your brain is very different than, you know what I mean? It's factual. These people are marketing to these people for a reason. They're not losing money.
No, it's definitely scary, and seeing numbers like that makes us, that's why we bring this up, is more the awareness.
And we've talked about it before this, and I just want to say this, if you are someone that is like, dang, maybe I am, just call a financial advisor, be like, hey, I don't like what I'm doing. I'd want to change it now, because it is a very addictive behavior. Yep. Gambling is one of the hardest addictions to break. Like, let's try and stop it now. Wow, we went on a little therapy session on that.
We completely did, but I think it's relevant. Like, very relevant, and we've seen it firsthand. Mm-hmm. So this is a second one, number 2 on the day. So Money Ed. April is Financial Literacy Month, so we're in the last day of March today. So April.
This will come out April.
But more than a third of American college students would give themselves a grade of C or worse when it comes to personal finance.
Really?
And 38% feel more comfortable talking to their parents about sex or politics than financial matters. This kind of compounds into that, hey, as you get to become a younger adult, maybe making some poor money decisions, not leaning on anyone, or maybe a little uneducated.
What was the generation? Say that again.
Yeah, so it's college students, college-age students.
Which is interesting, because I feel like they have so much information at their fingertips on personal finance. But again, I think it's interesting that they won't talk to their own family about it.
That was from Wallet. The source was Wallet Hub. Yeah. So
especially politics, because that's like a hot button for a lot of families.
They'd rather like.
But it all intertwines. We talk this. Money touches everything, and I think there's so much. We talk about this. There's so much shame around money and people not understanding.
That's probably what it is.
Yeah, I want to know, but I don't know, so I'm not going to ask.
Or the parents' shame.
Yeah.
And then it's like, oh, the kids just don't talk about it, right? So that's the kind of compounds of your generations.
Do you think it's more they're not talking to their parents, or they've never seen their parents talk about it, so they're not yet?
It's definitely more how you were growing. Like, if you never talk to your parents about money, when you become a young adult, you're probably not going to talk to them about money.
Exactly.
Right? So versus I think as a
lucky
parent.
for Kale, Day, Can, Call it. We're in Cam. They're just hearing chirp, chirp, chirp.
Yeah, I know. Poor kids. So, but whether you talk to your kids about money or not, I do think, or if you have, you feel like you have money, or you come from a place of weakness, place of strength, I think it's very powerful. Even if you're a parent that, hey, I didn't do your best. I didn't do my best.
So
hey,
I want more for you.
Tell your child, like, hey, I didn't do the right things. Here's the things you should do, or here's the people you should talk to try to get yourself on the right path, because I didn't do it.
Or more powerful, and I have heard parents say this, I didn't do it. I don't know what I'm doing. Go find someone that does know what they're doing. I wish I could sit down and talk to you about this, but maybe we go find someone together, because I know.
I've had that. We're a mother and a daughter come in. They're both like, we both need help.
Yeah.
So
we talk about this a lot.
Ask for help.
Yes. Awareness, bringing light to the situation. It's crazy how much you can accomplish when you just say it out loud.
I'm doing my best talk show host of
flip it. That's what it should be. Cole's Corner.
Flipping my note card.
You know what rips, dude, is Cole's Corner.
Oh, gee, Merry Christmas.
You had to be here for the pre-show for that one. All right, so let's go into this. So we talked about the market volatility. Cole, tell me exactly what's going to happen in the market this year, so our listeners know what to do. No, I'm just kidding. You can't do that.
We're going up. No, I'm just kidding.
Okay, but we're going to talk about the questions we're hearing. And first one I heard this morning when I got Stella's coffee, best coffee in Fort Dodge, Iowa. Sorry to everyone else. Is the market going to crash? What are we going to look like this year, Cole? So what do you tell to people when they come at you hot? Like, what's the market going to do?
Yeah,
what does it look like? Is it going to crash?
Is the market going to crash, right? That's such a broad-based, like, what does that mean to anyone, right? A crash might be 10%, when in reality, I don't look at that. I was like, that's a little pullback.
Little market correction.
Yeah, I think of a crash, or a real drastic would be a drawdown that lasts for a very long period of time, right? So you think of, like, in my mind, a recession or real down period in the market's going to be for longer duration, versus a pullback is generally for maybe a quarter or 3 or 4 months. And I think we're more in that camp of, hey, it's more of a pullback, not so much as a long-term drawdown. But again, there's always factors that can compound and kind of change things. So again, when people ask this, I always put it back in perspective of, like, well, one, what is our time frame that we're looking and trying to judge on? And does this, have we accounted for this? Have we planned for this? Have we talked about this? Most clients that work with us, we talk about pullbacks, right? Because we know
it's our job. Like
we get very complacent, us included, when everything's green and the markets, from January and February.
Everyone's lighter walking in the office.
It was great. Yeah, it's like great. The numbers are up every day. We're up. We're green, and now we've gone through a very quite a decent period of time where it seemed to be red. I think today was up. Hopefully we can reverse the trend today. But I think that's a great time to kind of calm down, right? And zoom out, right? Okay, what's going on, greater than just my portfolio of things. Because sometimes you can't control everything.
No, and again, I want to normalize this. Pullbacks are a part of the market. Like we are not, and I think we were a little spoiled, the last couple of years. But I just want to read some of these off because I always say this: we are not immune to the world happening. We are not immune. These are way past our date. Think about this. Okay, so I'm going to name some of these world events that have happened way past our time. World War I. Inflation, the Vietnam War, Black Monday, Lost Decade, Great Depression. And all these things are very emotionally and scary. And these are just some of COVID.
If you can see, we're looking at a chart for the listeners, and it's, it's
up and down,
a line graph that's literally, or what is this? A line graph? Yeah.
Yes.
What would this be? Yeah. So,
you gotta get back
don't know my
graphs.
We're off topic here, but we were talking about how the teachers teach our children now.
Yeah, we don't know what you guys are doing.
I can't help them with some of the ways that they do math. They teach like some math concepts and things completely different.
How is my 9-year-old doing this box math?
I'm always like, what is that? Like Kale's like showing me, no, this is how we were taught. And like, we were doing like long division or something. Yeah. Like, I can't teach you. I cannot teach you this.
It's really a patience thing for me. I always tell Dad's the homework guy. Anyways, focus. So my point is, these things are going to continue to happen. We're going to hear headlines.
There'll be something, in the next 12 months or the next thing after we get this problem solved, there'll be another one around the corner.
And me and Cole were kind of talking about this. I asked him this yesterday. I was like, do you think because we're such advanced, like, you think about AI, like in even COVID, like the seems thing, and I'm not saying they will at all. I'm just saying it seems like the market corrects itself quicker, and which that could be wrong. But I'm just saying like, it's very different from 1980 than 2026. But my point is, we're still not immune to life events. Things are going to happen. No one in their right mind could have predicted COVID.
We're definitely more efficient in the market. So I think the movements happen more violently at times, right?
Thank you.
At times. But again, there's always some anomaly around the corner or something new, right? I don't think anyone saw the advancement of AI, right? And how we're applying it to everyday life and how quick that's kind of came around, right? I think that like when we do have the innovations, they just happen faster. So,
and I don't think the question is the market going to crash? I think the better question is, am I prepared for the downturns? Am I prepared? Is my plan? Do I understand what I'm doing in my life to prepare if we do have a long downturn, a recession?
I would ask this question to yourself. Yes. If the market does crash, and let's say crash is 25%, for 12 months, can I be patient for 12 to 18 months while things respond, or maybe 2 years if it's really bad?
That's a good
Can I be patient and ride out the wave? Because knowing that, hey, I don't want to make a decision or sell up my equities when I'm down 30%, right? It's like,
it's the worst time.
Yes, right. Generally the worst time to sell is, when you're really going through that down period. If you can, you're like, oh yeah, my timeline's beyond that. I can be really patient. I can actually add to the portfolio. Great. I'm just more dealing with the emotional side of seeing negative statement values.
I do love my clients. Sometimes I just don't look at it because I know if I look at it, I'll be reactive. So, you know what I mean? I just trust you. I know what I'm in, and I'm just going to...
I try to get people to be less aware when we're going through the tougher periods, but it's just so relevant everywhere. You flip on any news cycle or get on X or any social media platform, someone's putting a video out about how negative things are or whatever it might be, right?
But headlines aren't going anywhere. They've always been, you could Google old newspaper headlines and you'll see the Wall Street market is crashing. We're all panicked. There's always things that you're going to find. So the next question, I feel like we're getting a lot in this, we kind of cover this. Do I need to change my portfolio, Cole?
Yeah, this is, again, a valid question to ask. Yeah, and it really piggybacks on... Yeah, I went through that whole, analysis of like, hey, if I can be comfortable or not.
But this is the question we're hearing.
Yes, is like, I think now is not the time to make the change, right, to the portfolio. But if you are having, either a lot of anxiety or you're staying up at night or you're thinking about it all the time.
Please don't.
But we don't want people to go through that, even if you probably are someone that, hey, we probably do need to try to grow still. And there are people, and that's really what is going through that analysis of like, how aggressive, conservative do I really need to be to achieve my goals, right? And if you're someone that's just super uncomfortable with things, yes, you probably do make a change. Not at this, exact moment, right? But just know, hey, let's earmark that conversation when things maybe get a little bit more normalized. Let's go back and revisit that. And that's generally what we're doing. If we say we have someone coming in for an annual review around this period of time, and we're like, hey, we've got to
You're doing the report. You're like, dang, this would have been nice to print 3 months ago.
Yes, yeah, it's all, and that's where
that's a reality we live in.
It's like, hey, we got to show the good with the bad, right?
Yes.
We love to show when numbers are great and up, but the reality is it's not always the case, and we're not going to have a perfect picture all the time. But it's a great time when we're like, hey, we're down 7, 8, 9, 10%. How do you feel? Like, how do you feel about that? Are you okay? Like, yes, hey, do
you understand our long-term plan?
And generally, like, hey, we've planned for this. We knew this was going to come. We're doing the right things.
Cash you want to put in?
Yes, exactly, right? And those are the conversations. And I think the more you're aware and you can get to start to zoom out to bigger picture, the more comfortable you really are in these down periods.
And again, I challenge people. Like, I think the market, like, it's such a headline thing, but when you hear the points are down, the percent, a lot of people are like, what are they talking about?
Yep.
Like, again, you're not just in one stock. We're diversified. We have all these plans in place. But another question we hear a lot during this time, should I change my portfolio? And should I put it in cash? Should I have money in cash? What would you say, Cole?
Yeah, I mean, I try my best.
We talk about money in the market versus out of the market all the time.
I try my best to always, if someone wants to lighten up a portfolio, generally there's some give and take there. If someone's really, really uncomfortable, for the most part, most people that I deal with, I think we do a really good job on the front end of talking about volatility, and it prepares them for this. And I have the same people that kind of have the same talk track with a lot. And then generally we'll get 12 months down the road, like, God, I'm glad I didn't make any rash decisions at that time. And really, we'll say this a lot. It's time in the market, not timing the market. So again, and there's so many stats, and Baileigh put another chart, chart in our podcast outline of, and what this is, and this is a little dated, but there's JP Morgan puts out a piece called Guide to the Markets. It's for financial advisors. You can look it up. It's for individuals as well. But they have a bunch of stats on if you miss the top days. And there's so many statistics out there, is like your returns come on so few days in the market that if you miss those days, you end up having a negative return, or, and you can pick any which period of time. But again, that's where we see that, and like, hey, understand the good's going to come with the bad, right? There generally it's better to ride the wave than to try to anticipate when to get out. Because anytime someone does overrule me and says, hey, nope, I want to get out, and I always make that clear.
You're in control.
You're the boss, so that's fine. It's your money, but you're going to tell me when to get back in, and that is the hardest thing to do, is when to get back in. Because most of the time, what happens? We rip down. We get a lot of return back in 2 or 3 weeks, and you're like, oh my gosh, I missed that return. Now I'm repurchasing, and I absorbed the loss. I absorbed the loss, and I'm repurchasing at a higher level. Because
taking control, and I'm doing this in quotations, because you got to remember what you can actually control in your life and what you cannot. Taking control by selling out of the market after the worst days, you're most likely going to miss out on the best days. You are. It's statistically proven. Like, if you panic and you emotionally put the cash aside and you are like, great, I missed out on the worst days. Well, guess what? You're also missing out on the best days. And we talk about this too a lot. Again, this brings back to, well, do you have an emergency fund anyways? What do you make? Are you living on a lot of debt? Do you have no debt? Because I can tell you right now, it's a lot easier to handle market volatility. When you're sitting on cash, why would you add more cash to it?
From a position of strength, right?
Because we always tell you should have an emergency fund anyways before you're chucking a bunch of money in the market. You should know, if Luke lost his job, we can replace his salary for 3 months or whatever it is, whatever your comfortability is.
Comes back to planning, right?
Yes, and that's so. Again, when I have people like, oh, I really want to start investing, I'm like, but you have $300,000 of student debt. Like, we can't, you know what I mean? It's like having those conversations. Yes, I want you in the market at all times, but first we got to take care of your foundation. And again, the people that have strong foundations are the ones that can ride out the market volatility.
And I will say, sometimes it seems like I get these questions from younger folks too, more, and maybe that's just like newness to pullbacks and different things though. But if you're young going through this is actually, perfectly fine. And it's super advantageous if you're someone that's contributing every week to your 401k, whatever it is like, hey, you're buying at 7-10% discounts each month. So you're putting in $100, that $100 going 10% further on the shares you're purchasing. You shouldn't even worry about it. If you're in your 30s and 40s and you're like, I'm retiring at 65, your retirement account values, yes, everyone loves to brag about their value, but at this point it is so irrelevant from when the time you're going to be using the money. It doesn't matter. It literally doesn't matter other than to you on a number you're putting on your balance sheet.
I want to bring this up too. Cash does feel safe to a lot of people. Like it does, but long term, it really is one of the risky decisions. Do I think cash on hand is very powerful? Absolutely. So when life happens and you got to pay for something, you don't have to pull it out of your Markket account. You don't have to pay for 401k, but also too much cash sitting idle. We're living through inflation. Like your cash sitting in the bank making nothing is actually losing money. And I think that's really hard for people to frame. Now, I'm not saying no cash. Absolutely not. I have cash on the side. Like very situational of your situation, but I'm just saying it's risky.
If the majority of your nest egg is there, and it's really those people that are always like, hey, if my retirement assets are going to produce an income for me in retirement, that's the really scenario you go through is like, okay, if I have $1 million in cash and I just have it all in cash and not invested, just do a little scenario of, hey, I start taking, I'm making 3%, but say I need a 3% distribution off that.
Yes.
See how long that lasts versus going in the market and doing the same exact thing over a 30-year retirement period. Yes. You'll lap it any time period you pick, doesn't matter. You could pick the worst times to start investing anything over a long period of time. Having a little bit of growth in your portfolio is advantageous because you're going to outpace the inflation, but also, you're always just banked on getting fixed interest rates on that money, and you're very sensitive to what you can get,
you're subject to whatever's available. I really like how you explain that, Cole, but I think this question goes hand in hand, and you've already answered it. Should I stop investing right now? Absolutely not. Because longevity, we are living longer. Like we are so advanced in the healthcare. I mean, the healthcare system is its own beast, but I'm just saying people are statistically living longer. People are having to go back to work because of inflation. Like that's why we want your money to work for you. That's why we want you to invest in times like this, because again, you're buying at a lower time. The market is always going to be volatile. If me and Cole work the next 20 years and the market's green the whole time, there's really, no one would, you know what I mean? It's just, life is so unpredictable, and just control your controllables. You can't control the market.
These are the times that if you're a person like, hey, I already have in my budget, I'm going to do a Roth IRA contribution. I was planning on doing it in January, but I have the money available. At the end of the year, say December. I had one this morning. He normally does it later in the year, and he called and was like, hey, I'm going to do my Roth contribution now. I just know the market's down. He's a long-term investor and did a max contribution this morning.
Yeah, I did that
before I came in. So
did that 2 days ago. I was like, why would I wait? I was like, I have the money.
Especially if you have the money available, right? If
and
you
know your situation. You got to know your situation.
And that's where, hey, this is part of my plan. I'm getting a little bit of a discount. I'm doing a little bit ahead of time. Those are the ones that generally, one, they have a plan. That's the common, and they're coming from strength, right? They've thought about it. They've either prepped the money aside, and generally we've had the conversation, and we're aware of, hey, this is part of what we're doing. We always have the people that I always say, hey, because it's so funny how quick the mindset shifts when everything's green and up. People are like, hey, what should I invest in?
Yes.
What should I buy? What should I buy? And then when it's like, I'll be like, hey, let's pump the brakes. Right, we've gone 3 years of 20% equity returns in the S&P. I'm like, just be a little patient here. Can you give me some time? I don't want to just barrel another X amount of dollars in the market. We're going to get some volatility downside. When that happens,
let's capture it.
It's okay you don't have to get every single gain when things are going up. So be patient. People that are patient are getting rewarded right now because, hey, they had some money to put in the market. And I kind of compile a list. It's almost,
you're like, I know they
kind of adds up, and I've got the people. And sometimes there'll be a few on that list like, oh, I'm going to wait actually. And I'm like, well, you were going to buy when we were all-time highs. Now we've got a discount and you don't want to buy.
Such a psychology.
It is. You get, because now all of a sudden the sentiment's a little more negative, right? People are like,
what you feed your mind. You keep hearing negative news lines, you keep hearing negative thoughts, then you're like, ooh.
And that's where, when you make those decisions, you cannot make them on a 3-month time scale. It's
No.
like, oh, I'm making the decision for 36 months, for
I think
3
you
years,
could say
5
that
years.
100 times in an
Yeah,
episode.
and it's so amazing that it's just, we see it in practice every day of like people, their mind shift will shift so quick. And I'm like, all it is like, hey, there's just pessimism around everything now.
We're glass half full.
It's wild how the stock market's like the opposite of like the grocery store. Like people didn't go out and buy all the eggs when they were $4.50 a dozen.
Yeah.
They waited until they were on sale and bought them. Like
Yes.
it's so weird how it's.
Peter, I tell people this all the time. I'm like, do you know how many people? I'm like, oh, I like your shirt. I like your bag. Yep, I got it on sale. Yep, got it on sale. I mean, literally,
Yep.
I could compliment someone. I guarantee if I went to work today and a girl had a new shirt on it, and I was one of the girls, and I would be like, oh, I love your new shirt. Yep, got it at Target on sale or wherever. And I'm like, they can rationalize buying stuff on sale, but the market, I know it's like, well, what if it doesn't come back? I'm like, then we all got big problems. And the market statistically will come back.
I was watching something on Charlie Munger, who was Berkshire Hathaway's. It was Warren Buffett's longtime partner. He passed away a couple of years ago, but there's a video of him talking about how I think it was 3 different times. He's like, because he'd always be like, when market, he didn't even flint, like didn't even think. He's like, market's down third, didn't even bother him one bit. He talked to 3 different times because most of his wealth was tied into Berkshire stock. How he had, I think it was 3, where his value of his stock drew down more than 50% 3 different times in his life. He's like,
no big deal.
I had no worries. He's like, I believed in everything we were doing, and obviously he was in control.
And he was less diversified.
Well, yeah, I mean, but think about that. Yeah. He probably saw his net worth cut in half multiple times. Didn't even flinch because one, he was a long-term believer, and also
he knew his long-term plan. He knew he was going to be working. He knew what he was going to be bringing in.
He knows there's a lot of irrational emotion when market drawdowns happen, right? And it was like, he's like, I'm going to be the rational one of like, I believe long term this will come back, because if it doesn't, right, and everything crashes, we're all in vacation, right? It's always like nothing matters at that point.
If the market crashes, like never comes back, and it's not working, I'm like, think about that. We're going to have a gap in the world.
We probably have a
Who's
destruction of our monetary, our whole monetary system.
We don't have the answers for that.
It's like, then it's all your hunter gatherers. That's all that's gonna be alive.
I have a friend. And he's like, I'm always like, because he's a hunter. And I'm like, I'm coming to your house. He's like, we're not going to my house. We got to go find empty land. And I'm like, oh my gosh, you're crazy.
We all have those resourceful people. They're like, okay, I'm going to find, if this ever does, all these like crazy people that say, and this does happen.
All the conspiracies.
I'm going to find you. I'm going to find you.
Okay. So true. Last thing, I think this is probably the hottest topic we've talked about, AI. I mean, we talk about it, the AI bubble. Is it going to crash? What's going on with AI? I had a younger person. All I want to invest is in AI, nothing else but AI. Like, yes, AI is definitely a hype right now. It's very powerful, but there's I
think it's to be determined on some things. There's so much real life application that it's not going anywhere.
No.
Right? Is there some overvaluation, or if you very subjective of what you're looking at? The one interesting thing, compared to the public market, so many of the AI companies are still private, right? So it's like there's actually probably way more overvaluation going on in the private market, which is kind of unique. But companies aren't going public as they're more profitable. There's like SpaceX. I'm gonna use SpaceX for example, right? It's been private. It's going to go public supposedly sometime this year. But those companies like that historically would have went public 10 years ago, a decade ago. And we're seeing the same thing in the AI market, but there's a lot of overvaluation from we're kind of hearing that. Do I think there's probably some froth in the system? 100%. But I also think the amount of value and creation that it's creating long-term and the efficiency.
It's just not going anywhere, but not every AI company and stock's going to make you money. You know what I mean? That's how I feel.
Completely agree. And I think there's my personal opinion on it. There's like 2 different applications. One's like your personal use of like your personal assistant type AI. And then you've got, you're replacing an employee.
Yeah.
And I think that's the side where, yeah, I know. I hate to say it that way, but that's the reality of like, you're hearing a lot of commentary around that and stuff. And there's so many things yet to be determined, and like regulation, how is it regulated, right? Those are a lot of the things that we don't really know. And I think it's, again, the how quick it's evolved, right? And even like in our everyday lives, think of how much you've changed just your personal behavior.
I don't want to tell you.
Yeah, around like how much you're using your use of AI, and it's probably would scare you, and that's just us, right?
So and we talk about this. I was talking about this the other day. Obviously, it's not going anywhere, but even my son, he'll be like, ask ChatGPT.
Yeah.
Ask ChatGPT how we can build this. And I'm like, wow.
I mean, it's and I would say I'm more just personal use at this point. I do some business application, but I just don't use Google anymore. Like it used to be my Google, like, that's what I would do on Google. And now it's like, I don't. Now I love it because it saves like your train of like how you kind of think.
It knows you.
Yeah, which is creepy. But
I was going to say, I'm thinking of an incident.
What do you think, Peter? What's your thoughts on that question? The AI froth or the AI speculation?
I mean, I use it plenty, but I think it's going to end up being like every car company since 1900 didn't survive, right?
Yeah.
Even though the car is like the
But
thing.
cars are still around.
Yeah, everybody uses cars. They absolutely.
There's gonna be winners
necessary.
and there's gonna be winners and losers, right? Completely agree.
That's it.
And I'm going to ask you this to end this, Cole. Do you hate losing more than you like winning?
I would say yes. I'm one of those people that fall into that category.
It will bother me if I lose way more. But the market, you're not always going to win. You're not always going to lose. It's like we understand emotions. We have them.
You lose when you sell.
Yes. Thank you. And my point is,
if you sell a loss, I guess. I guess if you sell a gain, But
but my point is, I truly believe there's always conversations around confidence, right? Where does confidence come from? It's preparation. And a plan is preparation for these times. And we wanted to talk about this today because there is a lot of news headlines. I mean, we are engulfed with them by our clients, like market volatility, AI, the war.
It's been pretty quiet though. I've kind of been surprised. I thought our clients would be a little more chattery, but I think
give it a couple months.
I think we do. Yeah, it's always the longer it goes, right? It gets more people get more growly. Now statements are about to come out. For our statement only people. Most people are online and see things daily, but there are a few people that are just like, oh, I didn't know my account until they get their statement, and then they know, and then I'm like, oh gosh, and we're hiding under the desk. So,
but. I know, and the phone's ringing, and it's always the same people, though. It's so funny. Yes. And then I love our clients, though, and I love personally mine because, like, again, it's just like the gambling thing we were talking about. Once they talk to us, they feel better. It's like they just have to get the emotion out. If you hold that emotion in and you think on it, but when you sit down, you call Cole Jaskin, you're like, what do you think? And Cole's like, stat nerding on his clients, like, we are prepared for this. We have planned for this. They do. It's instantly shoulders kind of relax, and we got the plan in place.
People want to know you're there and like, hey, they also want to know you're not the only one. Generally, if you're feeling a little frustrated, there's thousands and hundreds of thousands of people that are probably feeling the exact same way.
Yeah.
So,
and no one's immune to volatility of the market. So again, just know your plan, be prepared. I also want to mention April 25th.
Yep.
We have a 5K at the Fort Dodge Country Club. You can online find it on the Fort Dodge Golf Academy. I always mess it up.
Fort Dodge Golf Academy.
So if you're a local listener, it's a great time. Family, kids. We had a great time last year.
It's a fundraising event. Half the money goes to Children's Cancer Connection.
Yes.
Supporting families that have had their
children
been affected by
cancer.
Childhood cancer. And then the other half supports the junior golf organization that's affiliated with the Fort Dodge Country Club. It's a nonprofit in our area trying to grow the game of golf, especially
Check it out on our website.
Yep. Would love to have you. Hopefully the weather holds up for us. We had a great time last year, and hopefully we can repeat and really build on the success. So we'd love to have you as a participant, volunteer, or just come and hang out.
And if you are not in Iowa and you're a listener, you're like, oh, I love that. You can go online. You can still donate to the causes.
Yep.
So we always encourage that. But also like, subscribe, share these podcasts. Because if you have a family person, you're like, dang, I wish we could talk about finances or talk about market volatility. Maybe this is the podcast you guys need to listen to together.
Or respond to one of our videos or something with questions that you have. If you want us to answer a question or something about the market or something very specific, we love to always have the client question or the hypothetical.
Q&A.
The hypothetical segment, right?
The first rule of compounding, never interrupt it unnecessarily. Charlie Munger.
You've been listening to How to Money with Cole and Baileigh, the podcast of Full Swing Financial Planning. To learn more, visit their website at www.fullswingfinancial.com and follow them on Facebook and LinkedIn. Security and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA, SIPC.